U.S. stock prices are not too high. And I don't care what anybody says, they're just not. Now, yes, I could be holding myself out for a huge, scandal, you're so wrong, like Irving Fisher in 1926 and 1929. And then again, James Glassman in 1999. And if you're not familiar with Irving Fisher, I'll show you. A famous economist, Irving Fisher, and he said right here, stock prices have reached what looks like a permanently high plateau. And he could not have said that at a worse time. The end of the decline of the stock market will probably not be long, only a few days at most. And of course, that was wrong. And then he basically, everyone made fun of him for the rest of his life. And he turned around to be I think he was broke when he died, and broke and decrepit in terms of financial set. But it's funny because all the negative Nellies who prognosticate about the market collapsing and they never get laughed at. It's always just the guys who say the market's not too high. Then James Glass, as I talked about a video the other day about the Dow 36,000. He predicted that and him and Kevin Hassett would be at 36,000 by 2005 or something like that. And they were proven right. They were just too quick on the trigger for when that would happen. But anyway, so I will say, I'll go on record. You can laugh at me all day long. I don't care. It's stupid to say the stock market is too highly valued relative to PE ratios. I'll prove it again, once again. We'll start with this, though. And we got this right here, demographic changes, financial markets, and the economy. And I've talked about this a little bit on a video I did the other day. Stocks perform best when the roster of people in a country is the age of 35 to 59. All right. And when the roster of people aged 45 to 64 is growing, stocks perform best. That's what they say, which means one common theme emerges from their research that large populations of retirees aged 65 or older seem to erode financial markets in performance as well as economic growth. Right? Retirees are disinvesting in order to buy goods and services they no longer produce. And as they are no longer contributing goods and services to the macroeconomy, they're saying that hurts stocks as well as the overall growth. I'm going to get Knucklehead because I know he's on this steroid so he doesn't lose his bowels, but that makes him go pee a million times a Sunday. Buddy, just banged your head. Oh my goodness. He's a metalhead, just literally banged his head on the door. Okay. Anyway, if I don't take him, he'll destroy the house. And we don't want a pee-smelling house. I had a client once when I was at USA, and they had cats. Dude, I just remember going there. This is in New Jersey. Nice people, but man, I went in their house. I was like, whoo! I was like, do you not smell that? And I guess they did. It was crazy. I said, man, I'd rather you smoke cigarettes like my mom. When I go to my mom's house, it'd be cigarette smoke, which make me have freaking skin cancer and my lung cancer because we're so concerned, so much smoking. I'd rather go to my mom's house than smell that cat pee all the place. It was nasty. Anyway, so that's these guys right there. Growing the population, less GDP equals less stocks, blah, 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 high stock prices. Because he also says right here too, check this out. Higher yields signal high risk aversion, depressed prices, and higher expected returns. Higher yields. So basically, when there's high yields, that means the prices are going down. And now we have low yields, that means the prices have gone up. All right, that's why the dividend, I think the S&P 500 is like 1.1, 1.2. The 10-year treasury is still under 4, at least the last time I checked. Not sure it is right now. It's 9. Markets haven't opened yet. But that's low yields, which means high prices. All right, and as such, that would a lot of people impute that to say low returns in the future. All right, so let's show you what I'm looking at, by the way. I love Canadian pipelines, as you should too. I don't know if y'all can see this on my back. Can you see that? Yeah. Got to support your Canadian oil and gas industry. All right, so we're going to look at this thing from Grok I was working on this morning. Let's look at old Grok here. Historical trend. Let me make this bigger. Hang tight for just a second. Historical trends in U.S. stock market participation and household equity holdings. So we're going to scroll down here, and I'm just going to show you here, right here. We're logging this. You always want to log it. All right. Logging determines the percentage of growth from the previous period, as opposed to just a raw number. You never want to use raw numbers in this. You always want to log. So just keep that in mind. All right, but we're not this. All this says this isn't what I want. I want Grok to put it on the 2 axes. U.S. stock market participation, household equity holdings. All right, going from 1926 to 2024. Buddy, we just had you up here. All right, there we go. You can see right here. The number of U.S. stock market participants in 1926 was 2.9 million investors who had between them $20 billion of holdings. All right, so I took my trusty calculator. I said, well, what's 20 billion divided by 2.9 million? All right. The average amount people had who are investors, the average investor amount was $6,895. And that's in 1926 dollars, by the way. Just keep that in mind. So the average investor, remember, there's only 2.9 million investors, but of those 2.9, the average had $6,895. Fast forward that till today, there are 160 million investors with a total of $35 trillion. The average investor today, again, this is just the investor, the average investor today now has $218,000. Now that's average, right? That's not median, that's average, and this was average as well. So the median would be lower. I think the median is like 140,000 or something like that. But anyway, 218,000. And I said, okay, if we took just a simple 3% a year inflation, what would that amount be? And so if we took $6,895 and inflated that at 3% a year, the average investor would have $132,512 today. Well, 2024. But they don't have that. They have almost twice that. They got $218,750. So the average investor's holdings have jumped well above the rate of inflation. On top of that, the amount of investment of investors out there has risen significantly as well. In fact, we're going to come down here, and we're going to see right there. So here what I did is I plotted investor percent of investors change over the time period versus the balance change from the previous time period as well. So you can see not much change until about 1946, 1951, but again, not much change, and I'll show you in a better graph until we start going right about there when ERISA came in. And then all of a sudden, look at that. Look at the percent of investors changing. So ERISA comes in 1974. We start seeing significant change, but then a doubling of the change in the Reagan years. And look at the balance changes every 5 years. Look at that. Look at that. 2011 is down 20% from 2006. But look at that change right there. Going up, going up. Anyway, so we're going to see right here. Year over year, it's not quite as illustrative as I thought it might be. But anyway, you can see right there. Oh my goodness, that looks like a Nazi symbol, Josh. They had a guy, so stupid, no kings people. They said, oh, it was a Hegseth. He was wearing a red, white, blue tie. And they're like, look at Hegseth. It's showing that he's a troll. He's a Russian stooge. He's wearing a red, white, blue tie. I was like, oh, I thought I was a conspiracy theorist. Oh my goodness, he's no kings. Yeah, it was kind of funny. All right, but anyway, we're going to go down here. So I said to Grok, U.S. stock investors versus total population. So here you go right here. U.S. stock investors. All right, right here, you can look at that. Number of stock investors in the blue versus total population. See, look at that. From 1980 on, the number of stock investors just jumped up. Look at that. So you can see right here, total population is booming well above the number of investors. But right about 1980, right there, the Reagan years, the number of investors starts going, meeting the total population, if that makes sense. And as a percentage right here, it's probably easier to understand. Stock market participation versus number of Americans owning, percentage of number of Americans owning stocks. Check this out. Back here in the 1920s, only 2.5% of Americans owned stocks. Now it's 47% of Americans own stocks. You see that? So you see right here, number of Americans right here in red. Number of Americans, actually households or Americans owning stocks is right there in blue. You can see, will never be 100% because, my kids are, my youngest, well, he owns some stocks. But you get what I'm saying. If you're 13 years old, you're not owning stocks. But we're basically half the population owns stocks right now. That wasn't the case back in the 1920s, 1930s. It wasn't the case until basically right about 1996, 20% of the population owned stocks, and it just started going up, had a big decline, but this will never be changed. I mean, it could go down some, but it's not going to go down to less than a third. You're just not. It's crazy. You can see right here, less than 10% from 1926 to 1980 owned stocks. Less than 10%. Stocks for the wealthy. Retirement revolution, 401k push ownership to 15 to 20%. Tech boom pushed it to 40%. Crisis, we dropped down 32%, but now we got the retail revolution. Nearly half of Americans now participate in the U.S. stock market, up from 1 in 40 in 1926. So how can you sit there and look at price to earnings ratio when only less than 10% of the people even owned stocks back then? It doesn't make sense. And I'm not saying individual stocks, I'm saying mutual funds, 401ks, and whatnot. And I just did something else I thought was pretty funny. Oh, it was so much better back in the old days. I said, average annual household electricity consumption. When I was born right there in 1970, well, not 71, the average household consumed about 4,500 kilowatt hours a year in electricity, which is just about 25% above what China does right now, by the way. All right, very interesting. Now it's about 11,000. So we've more than doubled our electricity consumption. I mean, that's pretty significant in terms of kilowatt hours. On top of that, check this out. I said, well, let's air condition penetration. So just even having window units. When I was born, 54% of the Americans had some sort of electricity, air conditioning. That's it. About half the families in America had some sort of air conditioning. And you were still consuming 4,500 kilowatt hours. But how many had central air conditioning? And we didn't have a unit or window unit or central air conditioning. And when I was born, 25% of the population of all households had centralized air. Anyway, so for you negative Nellies out there, it's so much better in the old days, Josh. I'm like, yeah, you're consuming 4,500 kilowatt hours of electricity. The vast majority did not have central air conditioning. Half you had window units. I did not. Of course, I was growing in Maine. And meat was a whole lot more expensive relative to your consumption as well, your price as well. So things are pretty good. Anyway, the point being is at the end of the day, give me the argument why stocks are too high. And if your argument is based on prehistoric, because it was prehistoric, PE ratios from 1871 to basically 1980, I said, why should those be relevant now when the vast majority of Americans did not own these shares? Why would you use previous PE ratios? And I know what they'll say. Well, what else are you going to use? I said, no, I get it. What else are you going to use? 100%. That's my argument with tariffs. If you're going to say we got to use Smoot-Hawley as our tariff consideration, I would say, why aren't we using the other three big tariff bills previous to Smoot-Hawley? McKinley, Dingley, and then Forney. Why don't we use those? So, or maybe the answer is we just don't have enough data sets to say either way. But all I know is we have a number of publicly traded companies declining, plus a number of people investing in those publicly traded companies growing by leaps and bounds. Basic economics, man. Reduce the supply, increase the demand, prices go higher. That's just a fact. All right, love your thoughts. God bless. Smash that like button. Smash that like button. We'll see you.